Hello, and welcome to today's conversation, Lessons from Times the Bubble Burst. I'm Satchie Snellings, editor of live journalism and special projects at Protocol. Thank you for joining us. At Protocol, we aim to arm you as decision makers in technology, business, and policy with actionable news and analysis to help you do your job. Today, we're talking about something that's been at the front of all of our minds this summer, the economic downturn and its impact on the tech sector, and specifically what comes next for you as investors. As the old saying goes, if we don't learn from our history, we're doomed to repeat it. So today we are joined by a panel of VCs who navigated the 2001 and 2008 crashes to talk about the downturn around the corner. They will share lessons on how to shift strategies when the market changes, what emerging VCs should focus on in order to survive, and when it is and isn't time to make that next big bet. We're so glad you could tune in today. If you're not already subscribed, don't forget to sign up for Protocol Pipeline and Protocol's family of newsletters at protocol.com/newsletters. I'm excited to bring up Biz Carson, our moderator for today's conversation, to introduce our speakers and get started. Over to you, Biz.
Hi, everyone. We're so happy to have you here, and thank you to joining us from all over the world. I think this is an exciting conversation right now in this moment. There's a lot of confusion, there's a lot of angst, and there's a lot of opportunities, particularly if you're an investor. So I'm excited to be joined by Beezer Clarkson, partner at Sapphire Ventures, Geoff Yang, founding partner and managing director at Redpoint, and Matt Murphy, a partner at Menlo Ventures, to talk about what lessons they can learn from times the bubbles burst. And so to set the scene, I will let you guys introduce yourselves by talking a little bit about where were you and what were you doing during the dot-com boom and bust, the 2008 financial crisis, and now. So Beezer, why don't you start us off?
Sure. Thank you, Biz. It's great to be here. I'm Beezer. So I started my career in venture in the summer of 2000. There we go. So that was interesting. I was at a first-time fund, sub 50 million, with an incubator attached in New York. That was intriguing. Flash forward a year later, the firm had closed, returned money to LPs that were uncommitted, and we were one of many funds that returned money to LPs. So that's one discussion we can have. In the second financial crisis in 2008, I was at DFJ working with the DFJ network, which meant I was working with 16 to 18 funds around the world, including DFJ, and got to see a myriad of responses to that downturn and how folks both invested, updated their strategies, and fundraised successfully during that time. I am now with Sapphire Partners, which is the LP strategy of Sapphire, and we invest in early stage venture funds in US, Europe, and Israel. Back to you, Biz.
Geoff, what about you?
Hi, I'm Geoff Yang. In 2001, I was at Redpoint Ventures that we started in 1999. I've been in the venture business, this is my 37th year. And prior to starting Redpoint, I was at IVP from 1987 until 1999 when we started Redpoint. At this point, we've got 9 early stage funds and 4 growth funds. Oh, where was I in 2008? 2008, I was actively investing, watching the market crumble.
And Matt, what was your view of the world?
Hi, Matt Murphy. Let's see, in 99, I joined Kleiner Perkins in September, a month after we invested in Google. A startup that I was working at was just acquired by Intel. I came into the venture business all bright-eyed. I think the fund that I joined was already marked up 20x, and felt like I'd won the NBA lottery, and things didn't quite turn out that way. 2008, I just launched the iFund, which was a $200 million collaboration with Apple. So that was kind of exciting. I was on to focusing on the new mobile platform versus worrying about the rest of the world. It was kind of cratering around that. That was an exciting new era. And then right now I'm at Menlo Ventures. I've been here for 7 years, focused on the next 40 years of an already 40-year-old firm that I'm really excited about building.
So let's talk about the dot-com boom and bust. For those who haven't been through it, what was it like working in venture? Was there a particular wake-up call? Geoff, you mentioned it was maybe a better vintage for wine than venture at that point. What was that like?
Well, I remember that in that period of time, the 99, 2000 period, I used to have a presentation I used to have called These Are the Good Old Days. And there was definitely a feeling, having been in the venture business for a really, really long time, and seen kind of more normal markets, markets which largely didn't, there weren't that many consumer opportunities. Most of them were kind of back office, technologies. We used to talk about market sizes that were measured in hundreds of millions of dollars as kind of interesting markets. And then all of a sudden we got this boom. And it was really driven by the internet. And now all of a sudden you were talking about, addressing every man, woman, and on Earth potentially. You were talking about changing the way companies did their business, and there was a real feeling that it was a gold rush, right? And all of a sudden we were talking about markets that were measured in billions, and all of a sudden, everything that wasn't possible or wasn't really thinkable was possible in that period of time. And what ended up happening, and you could kind of feel it coming, was, there was, particularly for consumer internet businesses, there were all these new ideas and new models for, largely unproven for consumer internet businesses, and availability of capital to kind of pursue them. But there was really no near-term ROI for many of the businesses. And, that market hadn't really existed. It was all kind of on the come at the time. And spending on the consumer side was largely enabled by speculative capital markets providing money to spend, for potential markets. And when the money dried up, so did the spend, supporting those businesses. And at the same time, internet traffic was just growing like crazy. And so internet infrastructure was being developed and deployed. And what ended up happening was, the availability of capital also created, a vast excess of capacity ahead of a projected demand curve. And so you had fiber overbuild, too many core backbone providers. Eventually it was going to catch up. But when the bubble burst, the consumer side ran out of money to spend on large scale deployments. And on the infrastructure side, we were really overbuilt. And so what ended up happening is we had kind of 2 years, at least on the infrastructure side, to kind of work through all the excess supply that had been built while demand continued to nicely grow. And on the consumer side, all these businesses trying to rationalize a business that would, keep them in business. And it was, 2+ really bad years of a buyer strike. And that was really, really hard. I'd never seen anything like that before. All the other cycles that I've been involved with were just, more or less minor downturns. I mean, we had a legitimate buyer strike for all venture businesses for 2 years. And I don't think there's any innovative startup can survive without customers coming in for 2 years, because what happens is innovation gets stale, people get complacent, optimism dies. And it was just a miserable period of time to be in the business.
Geoff nailed it. That's about a perfect, summary. And that's how I felt. Like, it didn't matter what you had. You could not sell anything to anybody. And we can talk later about why this time might be a little different, but it was fiber overbuilt. It was eyeballs, and it was perpetual software where everyone was like, I've got enough for now. And then suddenly all those things kind of vanished, and everyone was kind of working through trying to figure out like how to make these companies survive that basically had no business model anymore. The floor just dropped out from underneath them. I remember, anecdotally, yes, it was kind of like everything was booming. And I think it was like February of 2000, Cisco kind of had this salvo across the bow. And at that point in time, Cisco was the bellwether for infrastructure and all the innovation around the internet and infrastructure. They came out and said that earnings were going to be soft. And that was just like, whoa, what just happened? And then from that moment on, it was just this spiral that never stopped, and things got worse and worse and worse, and didn't get just worse for like 1 year, it got worse for 3 years. The buyer strike is a great way to say it. So that's kind of my memory of that one big bang moment.
I have one interest. I'm sorry. Go ahead. I was going to just tell an interesting story in that period of time when I remember feeling like things were getting inflated, and so we started moving away, as some people did, away from consumer internet businesses, figuring that was more speculative, and we go into infrastructure where there was a safety in the harbor because you were betting, you were selling arms in a war. And I remember having lunch with a guy named Dave Dorman, who was running BT Concert at the time. And he and I were talking, and he said, "Yeah, I don't really know why, but there are four of us racing to build these backbone core infrastructures when you really only need two in the world. But the market is paying us to kind of go after four." And I remember leaving the lunch going, "Oh my goodness, we're going to get a rationalizing of the environment." And I remember saying to all of our companies, we should raise money, because there could be a winter coming, and the valuations were really high. And everybody went out and tapped the capital markets, raised a bunch of money. But the problem is they didn't know how to stop spending, and they couldn't stop spending. And I'm not even sure they could have pulled back the spending long enough to survive a 2 or 3 year downturn. I'm sorry, Beezer.
Oh, no, understood. I was gonna say I have similar experience. So I was coming out of grad school in 2000, and tech was the hottest thing possible. It was really similar to like take away the pandemic, but 2021, right? To the point of everything was spending. Like, do you want a slide in your office, or do you want a ping pong table? Maybe you want both, right? Like the whole 9 yards.
Both is for sure the answer.
Both is clearly the answer, right? And literally everyone in my business school class it was very stereotypical, pivoted hard from banking or private equity to venture or tech. And really folks went into startups because there's not that many that went into venture. And fast forward a year later, summer of 2001, I would say down to a person, maybe the one person who was working at Google, everybody else was laid off. Either at venture funds that shut down or cut back or whatever it was, or they were, to your point, Geoff, like the companies just went out of business, because if they had a business model that was reliant on other startups, it was like that domino effect. And so it was, when you're young, it's hard, but you can bounce back and learn from it. So, and I don't want to steal too much from our future conversation, but I think it's really interesting starting your career during a hard reset, because you get a little bit of the like, oh my God, it's so awesome, the up of the roller coaster, but then you also get a really good lesson in it's not always easy, it's not always awesome, it's not always up and to the right, and that's reality. And if you want to be in this business a long time, either as an operator or as an investor, you being able to work on both sides of the equation are critical. So was it hard getting laid off? Yes. Not going to say no. Was it scary? Yes. But there's lessons to be learned. So just sharing that. Because yes, I was laid off. Our firm did cut down and shut down. They wanted to return the capital to LPs. And just FYI, one of the people I worked for was Albert Wenger. He's come out of this just fine. So it all works out.
And so compared to the 2008 financial crisis, that was a bit of a different set of issues. And Beezer, why don't you start? Because you did have visibility into a lot of different companies through your DFJ network, or a lot of different funds through the DFJ network.
Yeah, so the 2008 was much more macro, right? I mean, we were worried, we being everybody around the globe was worried about banking institutions crumbling. In the US, there was a massive housing challenge, which was wildly different from 2000, which had other stock market issues, but it was more localized in tech. So I would say there's more analogies for me personally. I'm not an economist, so people feel free to disagree with me, but it feels more similar to today when there's macro issues at hand than in 2000. There are some similarities to 2000, but on this one, it's more of a macro issue. And so 2008, there was a lot of figuring out how to weather the storm. But it was, maybe it was because there was more some experience to it, but it felt to me like people sort of understood how to hunker down and manage through it better and respond through grit and determination and business model flexing and sort of being patient versus just shutting down. And I'm going to throw it back to my colleagues on the panel on this, but that was our experience. And maybe your fund that was raised was smaller. Maybe it took an extra 12 months, but we didn't see the same things that we saw in 2000 by any stretch.
Yeah, I mean, I'll just add it. 2008 felt much more like, it was an immediate capital market crisis. There was a big macro crisis. You were wondering whether the other shoe was going to drop, but it didn't immediately hit home in venture like 99 and 2000, where it was like the demand crisis that Geoff mentioned. it dipped, but it just wasn't as hard of a reset. So I think there was a lot of nervousness and kind of course correcting, but it also lasted a lot shorter. I mean, the 2000 to 2003 reset lasted like 4 years. This was kind of like 12, 18 months. I mean, you can even look at, back in 99 or 2000, the stock market was down 3 years in a row by 35%. And then, 2008, it was like a 1 year shock, 40%. And anything that's kind of that time bounded, startups were probably well capitalized enough to get through it. Problem with 2000 was it lasted too long and everybody started running out of money and didn't have, very robust business models, in combination with that. So different from that perspective.
Yeah, I completely agree. I mean, in 2001, we were at ground zero. The nuclear bomb blew up outside our bedroom window, right? In 2008, we were in the blast radius because everybody was in the blast radius, but it wasn't necessarily above us. Tech was still stable, and we were coming into this period of massive growth, on some of the trends like mobile. You think about the iPhone, it was launched in June of 2007. You think about cloud, Amazon launched its cloud service, EC2, in August of 2006. And e-commerce, while it had been growing and dipped negative for a really short period of time, like a year or something like that, it rose back up to its kind of 20% year over year growth, which accelerated in COVID. So, all the major growth drivers that have fueled our industry were really still really nascent in 2008. And it felt to me like a lot of the other downturns, economic downturns, that I experienced in prior times, which is you kind of hunker down, you get a little bit more disciplined, you work with the companies, you kind of cull the portfolio, but you still keep investing and you still keep a positive attitude. That was really, really hard in the depth of the downturn. At the end of 2002 and early 2003, it was really hard to be positive. And, we can talk later about the impacts on the psyche of investment professionals and how do you keep people motivated in that period of time when anytime they have tried to be positive and stick their head out the window or a refrigerator comes flying down from the upper level and takes their head off, right? And then when things start turning, I really felt like things were turning in the Q4 of 03. And I remember going into a partners meeting saying, okay, everybody, let's lean forward. It's time to get aggressive again. Things are turning, but not being able to change the mentality and the psyche of what had been ingrained for the prior 2 years. And that's a very real thing that I think we're probably going to get a little bit of that right now.
But think about that, Geoff. Think about like there wasn't a single angel remaining, not a single seed fund, and corporate VC all disappeared. Like the ecosystem just like withered away because it lasted that long. And that certainly didn't happen in 2008. It was a dip, but kind of a lot of the institutions still and individuals hung around.
Well, let's 100%. Talk about the big question of today then, as we look to the future. But does what's happening right now feel closer to 99, 2000, 2001 to you, or closer to 08? The good news is you all have jobs, so I think we can say it's maybe not as bad as the .com boom and bust, but what does it feel like today for you? And then let's talk about some of these issues looking forward.
It is the big question that I think a lot of people are debating because it's too early to really tell. I think that the main thing that's clear so far, it is a capital market crisis, and it's a capital market crisis that kind of feels as bad as 2000. But 2008 started off pretty bad as well. But it hasn't really hit as a full-on demand crisis yet, right? So I think we've started to see anecdotes of companies maybe missing by 10 or 20%. Things are getting a little harder, but it's not like, hey, 80% of the portfolio is suddenly reporting they're going to miss by 50%. It's just a little bit of headwind. So the real question right now is, does that demand crisis or demand strike start to creep in? Or things kind of gradually, getting worse quarter by quarter? Businesses are much more resilient right now. We obviously have recurring recurring revenue. We have a lot more eyeballs on mobile and web. There's real business models there. So I think structurally, both the venture business and the underlying businesses we invest in are different. But we just can't predict the depth of this recession and what really happens there. So that card's yet to be turned over. But if I had to bet, I'd say more like 2008, duration wise.
I agree with Matt. I mean, I think it's going to feel like something different and probably a blend of the two, because I think in terms of a bubble bursting, I mean, I guess if you were in the housing market in 2008, fall 2008 would have felt a lot like what our bubble bursting felt like, in 2001. But we weren't in 2008. We were really on the periphery, and it felt like more of a cycle rather than a bursting bubble. I think to some extent, from a valuation standpoint, it's going to feel like a bursting bubble. But from a fundamental standpoint, it feels different. I think they're proven business models. There is user demand. COVID pulled forward by somewhere between 5 and 10 years every trend, that the venture industry is largely going after, whether it's e-commerce or cloud or local delivery or cashless payments or, what have you. And the issues are really not as much a lack of interesting businesses with viable and proven models, as much as that valuations were too high, right? When valuations get too high, as a result of buoyant equity markets and accommodative monetary policy, you get some sloppiness, and a bunch of businesses that probably shouldn't have been funded were funded, or much less given hundreds of millions of dollars. And when capital is really cheap and undiscerning and plentiful, it always leads to excessive behavior. And markets, that's how markets go. Markets don't have any governor. They go too high one way, they go too low the next way, and for a short period of time, they find the right level until the next thing happens. And so, I think as opposed to 2001, where most of the companies went out of business, I think many will go out of business, but the ones that are going out of business are the ones that probably shouldn't have been in business if it weren't for a very robust and plentiful capital market, and that's probably okay. And I think what's going to happen is, largely for the other businesses that are continue to do well, it'll be a reset in valuation. You may get a slowdown temporarily as everybody possibly talks themselves into a recession, but I think that'll pick up because I think the trends are all in the right way. But people have to get used to a new valuation setting that is probably more like the traditional valuation settings, and that the old might be the new, and that what you were valued in last summer is kind of irrelevant to what you're going to be valued going forward. And people have to get comfortable with that. It's not like the high water mark is kind of where your manifest destiny is, right? The high water mark was exactly that. It was a high water mark. You never know when you're in it, but once you're out of it, you know that was the high water mark. Okay. I think our businesses will be fine. And I think the venture businesses will be fine. I think the firms that are biggest risk are the firms, and maybe some of the later stage growth firms, that provided hundreds of millions of dollars at very high valuations for companies that were kind of excessively spending on something that only works in a loose capital environment.
I want to pick up on something, Geoff, I really appreciate you bringing up, which is like the mindset and which ones serve us in different times, and how hard it was during the tough reset of 2000 to then believe it'll be better. And conversely, now when we've had folks who have only seen the up, right? 2008 was still quite a few years ago for lots of people, operators, investors, LPs, GPs, everybody. And so which lessons do you learn from the up that one needs to unlearn? Like last year might have been an anomaly and not what we should pin our numbers to. But what parts of that are still valid from do you bunker down so hard you actually hurt yourself more than you need to? And I don't pretend to have all those answers, but I think that mindset question is really going to be interesting over the next 12 to 24 months, because we're in a new world, and it'll have aspects of the old, and it'll have some crazy new thing that we don't even know yet, right?
Yeah, mindset is important in these things. I mean, if you adopt the mindset of 2000, you'd say There's nothing you can invest in right now or any portfolio company you have that will work. It was that bad. And then 2008 might lead you to believe that, all right, this is going to be shorter, so don't worry about it. We'll kind of get out the other side, pretty quickly, and all will be okay. So you don't really know. And I think that, what we're spending a lot of time on is looking at the demand signals from each of the portfolio companies. Everybody's kind of being a little bit more cautious, taking a little bit of fat out of the plan, if you will. But, you can't, in an environment like this, you can't just go ahead and say like, well, I'm going to assume there's going to be 3 years of the stock market being down by 35% in demand crisis. You're kind of constantly adjusting. So I think the mindset of companies right now is, hey, watch things quarter by quarter. Don't play quite as much offense, but still play offense. If you got a great product and you have customers that are being successful with your product, but be more measured about it until you know more. And that's, I think that some of these past cycles have helped with that mindset, but there is a whole cohort of companies and maybe investors that haven't been through this before and hope that things are like it was with COVID, where it was a big kind of, 1 month and then snap right back. And it's definitely not that, but we just don't know yet.
So what's
it's interesting. It's interesting. I think, we were talking about mindset and to some extent it's culture, right? It's culture inside a firm. And when things are monotonically declining, it's easy. You figure out what the right culture is, and if it lasts for a long time, you get the culture ingrains itself, and it becomes mindset. People start looking for reasons not to do things, right? When things are monotonically increasing for a long period of time, and we've just exited that for a long period of time, the point of view is, and you look around, and I hate to say it, but the venture capitalists are very much driven by what the rest of the herd is doing, right? When you're looking around and the people that are succeeding the most are people that are just writing checks, then what you do is you start hiring to that, right? You hire a bunch of people to go out, source deals, and process investments, right? You don't spend too much time trying to figure it out, trying to due diligence the thing. Basically, you want to put the capital out in the rising environment, and you want to be more discerning in a falling environment. Now that's easy to say because if you know which one you're in, you would clearly figure out what your strategy is. But when things last a long time and you look around and you think you're right, but you see everybody else doing something different and they're doing better than you are, right? Because you're not because you're in that period of time. You always second guess what you do. And a lot of people have come into this business in the last, 10 years or so in a monotonically increasing environment with a great capability and a great expertise and just finding investments and writing checks and kind of getting out of the way, right? And so now the question is, what will those firms do? The question will be, how long will this last? And what will those firms do with either those people or that mindset and the mentality? Because all you know is that when things change, you got to change with them. And the last thing I'll say is the reason this business is so much fun and so interesting is you never know a priori if you're right? And the thing I always struggle with is, when does experience become wisdom, and when does experience just become an anchor, right? Because I see it all the time, right? I always think a company won't succeed because 3 or 4 other companies have tried it, when in fact the time is different. They're doing something different, and the market is now ready. And my experience becomes an anchor, right? But it's sometimes when people start freaking out around you, and you are able to say, listen, I've seen these cycles before. We're all going to be okay. Keep a rational head, do the right thing, be bold. Don't let others kind of shape your thinking. That's when experience becomes wisdom. But the problem is, it's when you're in it and you're making those calls or guiding people, you just don't know. And that's what makes this business so much fun.
Well, this is a panel that values your experience and doesn't see it as an anchor. So, Beezer, I want to talk about the LP side of things. I hear a lot from VCs that they're open for business right now still. Are LPs still open for business? How are fund managers adapting right now?
Definitely adapting. I think the numbers that are out there, the first half of the year numbers, PitchBook and NVCA just put out a bunch. So they're there to look at, and they're obviously truthful, but they're backwards looking, right? Because I can say that it's already been 100 billion plus raised this year in venture, which is the same as last year, which hasn't been seen since 99, 2000. So it sounds like everything's grand. I think the experience of people on the street, though, is quite different because I think the go forward looks different than what's been the first chunk of the year. Notably, a lot of that money that was raised by larger established funds. And that's going to be very different for folks who are still building their business, who have not yet institutionalized. So the LPs are actively investing. I think a lot of them are having a denominator effect, which might impact the future commitments. So again, I guess what I'm saying is the first half of the year might not be indicative of what the second half of the year looks like. It feels to me, and I don't have the numbers to put to this, that things are slowing down. It's also the summer, which historically used to be a slower time. And I say historically, like 2018, 2019, right? We just went through a period of everybody's life in venture for being always on 24 hours a day for the last 18, 20 months. I think some of that is just natural that people are going to take a break. Budgets are pretty overstuffed. I haven't talked to an LP that invests in venture that hasn't said they're overallocated. And that is not necessarily a bad thing. They could be very excited about being overallocated, but there is just a lot of that. And when you combine that with
trickle down mean though, like if
it
every
means
LP says they're overallocated, is that the money that's going to walk out of the environment first?
I think it means people are looking at their budgets and trying to understand what the future holds. My suspicion is there's a lot of conversations going on between LPs and GPs asking for, when are you planning to raise next? And it's, candidly speaking, totally okay if it's not this year, right? The fundraising came closer to a 12 to 18 month cycle for many funds, and LPs are more used to, again, which was not that long ago, more of a 2 to 3 to 4 year cycle. So being overallocated doesn't take much to shift it back out. The harder question is when someone has liquidity at an LP, because remember, a lot of LPs need distributions to fund their business, and that's for endowments, that's for foundations. The liquidity coming back in is an important part of the cycle. And I don't know any LP that's considering a huge amount of distributions are possible soon, because look at the stock market, right? There haven't really been any IPOs. There's not a lot of exits. You'd be a bad fiduciary if you were suddenly starting to plan that. So I think the budgets are shifting on all those levels. So the long short answer is no, I don't think LPs that have venture as part of their strategy are out of the business. I think it might just be a bit more patience, like what we saw in 2008, 2009. Fundraising might stretch again for the average fund. But I don't think people are bailing out of the industry. At least I haven't heard of it. And I think venture has proven itself to be, through all the sort of announcements funds have made of what they've returned, that there's a lot of data out there that says that it's a meaningful part of someone's portfolio, or can be. Right, I'm just an N of one, just speaking as a person, not as a economist telling people what to invest in. Sorry, compliance officer makes me say that.
Matt and Geoff, you guys are both at established institutionalized funds, but what are you saying to emerging fund managers right now who hear from LPs that they're overallocated? How should they be playing the market right now?
I don't know that I spent a lot of time talking to emerging fund managers, but I mean, a bit. And I think, it's really early is good, but just the bar is higher for milestones. You've got to back things that are less capital intensive in an environment like this. So that would be kind of like seed early. And then, I think on the growthy things, like, the valuations are going to be more attractive and I think people resetting their mindset around what's an outlier, and so the kind of percentage of companies being pursued, the valuation around that will be lower, maybe clearer, but there'll be a little bit of a messy middle, where companies it's less clear where that kind of line is between, hey, this is early, this is late, and the kind of markets they compress like this over the last several years. So the point of this relative to the fund question, I think you just have to define where you sit. I think people will start reverting back to their traditional swim lanes. And over the last several years, everybody's just been doing kind of everything. Late stage funds going down to do Series A's. Environments like this, you get a reset along traditional lines. And I think to some extent, LPs want that. And as an emerging fund manager, you have to have a personality. Like, who are you? What are you about? What's the alpha I'm looking for out of you? I'm exposed to that over here, so I want you to provide something different. So I think having that personality in this environment is more important than ever.
I definitely agree with the swim lanes comment. I think that will happen. My advice to emerging managers would be to get a more traditional investment pace. Typically, I think investor LPs and Beezer, you can talk about this, but I think they like to see a longer investment period so that you get some time diversification and that people aren't shoveling the money out the door, if you will. But we've been going on this pace where a lot of the funds have had kind of 18, sometimes 12, 18, 24-month investment cycles, where historically they've been more like 36 months, right? And if I were an LP, I would want something that would be a little bit longer. So one advice would be to an emerging manager is just kind of be a little bit more deliberate. You don't need to put the money out in kind of 18 months, because if you don't have any results in your portfolio, even if they're quality versus straight markups, you want to be able to market something for your next fund for LPs to look at and for them to really believe in you. If all you've done is put the money out and there's no way to kind of assess how you're doing, my guess is it's going to be harder to raise funds kind of in this next period. The second thing I would recommend is, you got a real opportunity to kind of go after quality, right? Because, in a market that is rapidly rising, where everybody's getting money, and people are just kind of writing checks, use a period where everybody's in shock to kind of go after the companies you really want and find a way to get in them. And you could probably get in them at a much better deal than you would have otherwise gotten. For instance, I look at some of the really great companies like a Stripe, as an example, that's had that even they had reset their valuation for kind of more current market conditions. You get an opportunity that you wouldn't be able to get into before. So that would be my advice.
And VCs love to say that they're open for business right now and making deals, but you're also hearing that it is hard to raise cash if you're a founder, and that things are a little bit more shocked or closed for business than you'd think. How should VCs and LPs be thinking about these next bets? Is it time to go deep on your existing portfolio? Is it time to search for new greener pastures that maybe have a cheaper entrance fee? How do you kind of navigate these in the short term and long term?
Yeah, I mean, I think there's a lot of narrative right now that, the VC supply side is kind of shut down. But the reality is there's not a lot of demand on the entrepreneur side either. There just aren't that many companies raising right now. Frankly, why would you? It's a bad environment. That VCs are kind of focused on their portfolio. Everyone's trying to figure out if another shoe is going to drop, when we find the bottom. It is summer. And as Beezer said, like, there never used to be a summer. There is a summer both for VCs and for entrepreneurs. I mean, a lot of people are kind of in flux right now. Companies are resetting their plans. You don't want to go out to raise when you're still trying to figure out, like, okay, I want to see where this quarter comes in, then I've got to adjust my plan. If you're doing that in the middle of a financing with a kind of demand market being fluid around you, that's just not a great state to be in. So I think for a basket of reasons, people are kind of waiting till the fall. I think there is some point of view that, well, what happens if things get worse? And so do you really want to expose yourself to that? Maybe you should raise now. But my sense is the majority of the market feels like VCs are busy with portfolios. Companies are busy kind of figuring out what their actual reset is, if any, the magnitude of it. And those things will be figured out sometime in the fall. And then the market will get a little bit more normal, not nearly back to where it was, but there'll be a more active fundraising market.
And correct me if I'm wrong, but it seems to me it wasn't that long ago when it would take 12 to 18 months between rounds was not considered long. It was more normative than not, versus we've had some underlying portfolio companies raise, 3, 4, 5 times in 12 months. And I would put that in the anomaly bucket, not in the normative bucket. Going to the mindset thing, I think for a lot of folks, this is just what it used to be like. It's not wildly different.
It used to be like, it's 24 months. And the only reason why these financings were happening so quickly is because there's the supply of capital and the valuations that people were offering were so high. It's like, why not? Now, when you've got such a large percentage of companies that took advantage of that in 2021, why do they want to come back to market if they don't need capital and they know the valuations are down? So that's another huge dynamic driving the lack of financings.
We're starting to hear a little bit about term sheets being revoked. Capital, I think BG was missing $250 million out of their latest round that investors haven't wired. What is the bad behavior that can creep in during this time? And what is your advice to VCs and LPs on what they should not be doing in response?
Well, there was this huge rush, FOMO, and deals getting done in a week or 2 weeks, things like that. That just created both bad behavior and expectations on both sides. So as we kind of come out of that, again, this mindset thing, people need to change mindsets around, what an investor actually expects and what a company needs to provide. The bad behavior side, I think there are still firms that were kind of charging so hard and had a systematic way of doing things that they get over their skis in an environment where they realize how quickly valuations are dropping or resetting or companies changing plan and things like that. But I don't think that's a small percentage of the market. And when you do that, those stories become kind of lore around you and your firm. And so I think people are very careful and reticent to not put themselves in that camp. And, when this founder should really know who they're getting into business with, both the firm and the partner and the individual. And we're back to a cycle. We're going to spend more time together figuring that out. So you're not surprised by an investor. You've known them long enough. They know your business and you really want to work with them. They want to work with you, not this, shotgun wedding dynamic that can lead to bad behavior like that.
I agree with that. One of the things historically when, we work with entrepreneurs is, I always say, hey, listen, take your time, really get to know who you're effectively going to marry, right? Because this is, we're going to be working together for 5 or 10 years. It's not like this is a 18 to 24 month period of time. It's much more likely we're going to be working for something that looks like 8 to 10 years together than it's going to look like 2 to 3 or 4 years together, right? And I'd be really surprised if any of the reputable firms are doing some of the things that you're talking about, because the reason they're reputable is because they've been in business for a long time and reputations really matter in this business. And so, it's an opportunity, I think, for the more established, more reputable firms to kind of now distinguish themselves versus people who kind of jump in the last minute and people who write checks without doing any due diligence and all that kind of stuff. And that historically happens. All of a sudden in downturns, quality starts mattering again, right? And the firms that have a good reputation, that have the expertise, that have a culture that helps build companies and work with entrepreneurs, they tend to get stronger in a down cycle. During up cycles, new entrants and people who kind of just jump in and end up doing well, and it's really hard to differentiate what you do, because in some sense all money is green.
On the relationship part, from the LP perspective, LPs have relationships with GPs for multi-decades, right? Because each fund alone is about a 14 to 15 year life cycle. So that the whole quality of the relationship really, really is important. And LPs really consider that. And to your point, this is a really good opportunity to then re-communicate. And one could sit there and be concerned that an LP will or won't be there, but it's a great chance to reach out and say, hey, and we're having this happen currently in our portfolio. Hey, here's the state of our portfolio. Here's where things are at. Here's a percentage of companies that have runway. Here's whatever it is, whatever the right sort of way of processing and thinking through the portfolio and where the risks are. GPs doing that and sharing that proactively with their LPs. It happened during the beginning of COVID. We're seeing it happen again. And then sending out capital call schedules. We've had a number of people say they're slowing down their investing, which we all feel in the market. But then from an LP perspective, it helps to then not, I put it more in the budget standpoint versus LPs ghosting GPs. But if they know what to expect, it makes it easier to be there for it. And you don't have to wait for an LP to ask. Being proactive on that. I've yet to meet an LP who's like, oh no, proactive communication, that's terrible, right? I think it's always appreciated. The same way I'm sure GPs appreciate it when entrepreneurs reach out and say, here's a state of my business. Here's what's going on. Here's what I'm thinking about.
So we've talked a little bit about the mindset shift. There has been this generation of investors who've only seen things go up and to the right. And now they're in a time where even Stripe is taking a 30% hit, and they're one of the best startups out there. So how should firms be approaching the people management side of things, and having investors keep their conviction even during these hard times?
Well, I think one of the first things people who come into the business, some of the younger people who come into the business, I think what I've witnessed is many of them are kind of freaked out. And the first thing is to say, hey, listen, it's okay, right? Things go up, things go down. We're going to be in business over the long term. Don't freak out, right? Just work through the problems. Let's be a little bit more discerning. Let's do our homework a little bit more, but let's keep investing in quality companies, because that's what we do. Some of the best companies will be founded in this period of time, and we shouldn't stray from what we do. But don't freak out. And what I have noticed is that some of the younger people really have been shaken by kind of what's going on. And I think some of the more experienced, everybody's been shaken by what's happened with the stock market and what's happened with the value of their own portfolio and all these things. Okay. I'm not trying to belittle that, because I've felt the pain as much as anybody else, but I think, just keeping people calm and doing the right thing and doing the smart thing, and then doing what the ethic, it's really important in this period of time to kind of stay to your core values and don't panic. Cycles are part of the business, and strong companies will emerge and the weak will be culled, and it's a good thing, right? And so it's the same advice I give to companies. I think in firms, you treat the team like adults and be present, right? This is a time when kind of leadership really matters. Don't retreat and not be around. People will notice, and confidence and having consideration for others matter. And everybody is nervous because they're smart and they see what's going on in the world. But it's just that authenticity is really going to matter if you're managing a firm.
Yeah, I think there's really two sides to it. One is making sure, first and foremost, that people take it very seriously, that we don't assume it's going to be like the COVID downturn, and they were really digging in with their portfolio and really understanding what's going on. But as Geoff has said a couple of times, but also realize these things pass, and we're not going to be in this for many years, or I don't believe so. And start going back to doing some real fundamental thesis work. There's not as much FOMO right now. You've got time to build relationships for longer, to think about what's next, to dig in, to do your market maps, to kind of go out and meet a lot more companies over a longer period of time. And I think even for younger investors, their ability to win in environments like this will be higher. It's felt like it's just been so competitive with all these different sources of capital. Everyone's loss rates have been higher because there's been such an abundance of capital. And I think as people return to their natural swim lanes, there'll be more opportunity for up and coming investors. And we all know that out of this cycle, whenever it happens, whenever we start to climb out of it, that's when some of the most interesting, companies are built and some of the best returns are produced, not only because of valuations, but because of the way companies are configured in terms of the amount of capital they consume and the discipline along the way. And the one thing I try to help people think about, at least in the world of SaaS that I spend a lot of time on, is in the previous, especially in the 2001 downturn, there was kind of like buying from IBM was safe. There's no such thing like that anymore. And the second part was the CIO was the gatekeeper. So when the CIO said, no, we're not buying anymore, and IBM was big enough you could get most of what you wanted from them, or Oracle, it just shut the whole buy side down. Now we've got distributed spending throughout organizations. No one reverts to, very few people revert to kind of those incumbents, and just the whole wave around innovation through software is very powerful. So I don't think you can look at the past and say you should be as worried as that, because just the ecosystem is very different now. So things to be optimistic about, as I'm pointing to as well.
You stole my last question.
Oh,
so
sorry.
We've got a few minutes left. What are you optimistic about? And specifically, what signal are you looking for that might signal that we are coming out of the end of a downturn? Always good to stump people 50 minutes in. This is good.
Well, I don't know. I mean, I think the downturn right now is more a downturn in valuations. It is a downturn, I think, in the general economy and in the general psyche. The reality is that I think as far as our companies, you're starting to see some lack of visibility and maybe a little bit less confidence in kind of the growth. But I don't see a lot of companies really talking about, fundamental changes like, oh my God, we're going to go. And of course, you can't say this kind of uniformly across the board. For the most part, in the sectors in which we operate, there's still really good growth, and there's still really good, compelling architectural benefits and cost benefits and customer service benefits and all these things. And so I'm that gives me a lot of cause to be optimistic. In some sense, I think some companies are talking themselves. We're going to talk ourselves into a recession, particularly as it relates to kind of corporate spending. Some of it certainly on the consumer side, as you drain liquidity and you drain savings out of the system, a disposable cash is going to go down. And so you're expecting to kind of start seeing that. But I'm not sure we've really seen that yet. And so to be able to call when it's going to start turning up, I don't even really completely agree that we've seen it start turning down yet.
This hasn't been a very controversial panel, but I agree with almost everything Geoff said. But I do feel like there are more obvious headwinds right now. So I don't know how we want to call it as a downturn. Maybe not like the last two, but even ServiceNow came out and said, hey, the macro is shifting, and their stock took its biggest one-day hit ever. I think it was last week or the week before. So, but it's not, I think the point I agree with Geoff is it's not like that 30-50% miss. It's just kind of like a little bit off the top, whether it's 10 to 20%, and that's really tolerable. And if you can't survive that kind of, downturn in your business, if you will, or kind of marginal, reset, then you weren't that strong of a business to begin with. So I think a lot of companies can handle that. I think demand for software and other kind of businesses in our ecosystem right now is still really strong. So, a lot to be optimistic about, that we will come out of this, maybe bounce around the bottom over the next 12 months and then hopefully kind of start to move back up and out of that. But like, it just, I think it's very hard to forecast like, hey, there's going to be this 3 to 4 year thing based on what we're seeing right now. So that's kind of my window, is more like expect it to be hard for the next 12 months, expect it to start to get a little bit easier after that, but do not expect 2021 again.
I think, Biz, what you're hearing is I don't know early stage investors that are not inherently optimistic about the future being different and possible, because that's what makes early stage venture awesome, right? You're in the business of reconsidering the future. And I know I sound like I've drunk the Kool-Aid, but I totally have. I've loved it for the last 22 years. Plan on loving it for another 22 at least. But yes, and I don't know. I don't know how you call when we've come out. I think it's hard to know, to Geoff's point, if we've really actually hit a bottom. I think we're in the middle phase of the summer and everyone's waiting for the fall. And just reiterate, there's a bunch of macro things that are shifting that are way outside the world of tech. I'm sorry, with like interest rates,
right,
gas prices, a war, I don't know, all the supply chain disruption. There's a whole bunch of things that will keep the market feeling unsteady, and those could all get resolved pretty quickly, hopefully, but who knows, all outside of my control to affect, unfortunately.
But see,
all those have a play.
On that, I think like these are times when we're challenged to think outside of just like the straight down the middle. So many things have just been obvious, working by the basket, you'll do fine. And I think now we have to think about, okay, based on this, like what kind of value propositions are likely to outperform? So I think we're all kind of watching the portfolio and seeing, well, which types of value propositions, which companies, which verticals are doing better to get some of that primary data, but also being a lot more thoughtful and doing research on, hey, which vertical industries might we want to think about funding right now, or funding software into those than maybe historically we've done, just because there was so much of the more obvious stuff in front of us.
My comments earlier were more related to, I mean, it's pretty clear kind of overall global economy, we're in a downturn, right? And we're headed to a downturn. We may not have reached the bottom yet, but I'm talking about the industries in which we all invest, right? And I would say on a relative basis, on a fundamentals basis, the industries look like they're going to weather this storm possibly better than the general economy. Now, that isn't to say or belittle the fact that we've definitely had a huge downturn in valuations, right? But so far, they've been more a downturn on valuations than they have, real downturn on kind of revenues and earnings. Now, everybody is starting to say, well, how can it not happen, right? And there's been a re-rating in terms of what valuation multiples are. And the worry is that you get a re-rating, plus you get a downturn in the revenues and earnings, and then you get another re-rating, right? And so the combination of all those is an even more significant downturn on the valuations without necessarily hitting, the top lines in a way that, my hope is and expectation is that the industries in which we invest will, for the most part, be affected a little bit less from a fundamental standpoint, but we clearly are getting affected much more than other, stable, stable parts of the traditional economy, right? Because when interest rates go up, growth stocks get absolutely, hammered, obliterated, and especially after a bubble, it's going to be a lot worse. But, my hope is that, the industries in which we invest are still got these fundamental tailwinds behind it, and that we'll be okay, but don't expect the valuations to go back to where they were before.
Exactly. If you juxtapose like the market downturn of all the high flying recent IPOs of stocks we all love, Snowflake, Zoom, DocuSign, whatever, those are down like 80%. And like maybe their demand is down 10% or maybe not at all. So that's like what's so hard to rationalize right now. And the reality is the market just had the high flyers mispriced. And so, okay, but that's a pricing issue, but it doesn't mean that the fundamentals, that the bottom has dropped out in the same way at all.
Well, thank you, everyone. I know we've been worried about talking ourselves into recession, so hopefully we've talked ourselves out of one on this panel, or at least shared some experience to make it less painful for everyone involved. So thank you all for taking the time today. We really appreciate your viewpoints on it and your experience navigating this before.
Thanks a lot.
Thank you.
Thank you.
Thanks, everyone.
Bye-bye.